Hi, everybody. Thanks for joining the program a little bit early. We really got a great show for you today. Fantastic speakers, good topic on how to source deals in a slowdown. I wanted to just let you know about a few resources available to you from the GoToWebinar control panel. You'll see there's a handout section toward the bottom. That's where you can download a copy of the PowerPoint presentation for today's program. There's also a slide presentation with results from a survey of BD professionals that we did about 2 years ago. So it's pretty valuable statistics showing sort of industry-wide practices in deal origination. So we're going to get started in just about 3 or 4 minutes. I wanted to reward some of you for showing up early by giving you some personal insights into our slate of speakers today. So I want to hear from each of our speakers just about a hidden talent or a hobby that you're pursuing. Harv, we'll start with you.
I knew you were going to start with me because I don't have an answer. I will say that before everyone joined, I was thinking about this. I would say that my hidden talent is that I'm bad at golf, but I love playing golf. So anyone out there who's listening to this, I'm always open for a golf game with anyone.
Okay, thanks, Harv. Up for golf for sure. Andy Morrow, Houlihan, Lokey. What's a hobby or hidden talent?
I guess when I'm not at the Little League field all spring, it's trying to up my barbecue game. So if anybody out there has a big green egg, that was my secret hobby that I took up in the middle of COVID when we were all stuck at home.
Okay, barbecuing. That sounds like fun. Nadim?
I will definitely take Harv up on a round of golf anytime. That sounds great. I would say that one of my hidden talents is that I have a very good sense of smell. You know, it's like my superpower. I can smell things, which made, when I got COVID last year, over a year ago, it made COVID very challenging because I lost my sense of smell and taste. But that's a little tidbit about me, a little superpower.
Now, how did you realize, Nadim, that you had a sort of an extra sensitive nose?
Sometimes it's a positive contact, sometimes it's a negative contact where I can smell, like, you know, perfumes and lotions and different things from a very far distance. But yeah, it's something, you know, and then, you know, people around you can't smell it, so just that's pretty much how it revealed itself.
Okay, very interesting. And Dominic, hidden talent or hobby?
Sure. So I actually grew up playing pre-professional classical music. I was actually a first violinist at the San Francisco Symphony Youth Orchestra when I was at college at Berkeley. We did a concert tour in Europe, which is probably still today one of the most invigorating experiences I've ever had in my life. So today, not quite as talented musically, given you know, work demands and all that, but I still very much enjoy the arts and spend quite a bit of my time participating in various nonprofit organizations.
All right.
Hey, Dominic, I saw a movie Tar recently with Kate Blanchett, and she's a maestro of classical music. I think you might enjoy it.
Yeah, most definitely.
All right, super. So let's get started with the program. I just want to welcome everyone. Good morning and welcome to a special Private Equity Career News webinar. Our topic today is effective deal sourcing in a slowdown. I'm David Toll. I'm the publisher of Private Equity Career News, and I'm going to be your moderator for the program today. I'd like to start out thanking our sponsor, SPS by Bain & Company. SPS is an award-winning provider of actionable data and analytics for private equity firms that are seeking to optimize their deal sourcing efforts. A few housekeeping announcements before we really get underway here. First, a friendly reminder to any reporters on the program today that we are off the record. Please reach out to the speakers individually for permission if you'd like to use anything that they say in an article. Second, you can download a copy of the slides directly from the control panel. You can also download a copy of the results of a 2021 survey that we did of business development practices in private equity. Third, later today, I will send you a recording of the program, so there's no need to take extensive notes. And finally, many of you asked questions of our panelists when you registered for the program, really good questions. We will plan to address those during the discussion portion of the program. However, you can also ask questions anytime during the program using the question feature on your control panel, so please avail yourself of that. If we address all of your questions today, that will be a real measure of our success. So I'm grateful to have 4 expert speakers today to help navigate us through the topic. Starting with Nadim Malik, founder and CEO of New York City-based SPS by Bain & Company. Now, Nadim is going to present statistics describing the somewhat deflated state of the M&A market. He'll also address the role that technology plays in helping deal originators see the highest possible percentage of relevant transactions. Then the rest of our speaker slate comes from the West Coast today. We have Harv Barenz, partner at Palo Alto, California-based private equity firm HGGC. We have Dominic Chan, director and head of financial sponsor coverage at San Francisco-based investment bank Vaquero Capital. And we have Andy Morrow. Andy's based in Los Angeles. He's managing director in the financial sponsors group of Houlihan Lokey. So I'd like to get a little more detail on our speakers. So we'll just go around and Harv, starting with you, tell us a little bit more about HGGC, your investment strategy, and your role there.
Yeah, so happy to be here. I've been at HGGC now for 15 years. As David mentioned, I'm a partner at the firm. I lead our business development effort. We are investing out of Fund 4 currently. Our 4th fund is $2.5 billion. Our focus is really around partnership, and I'll try to keep that to a minimum today because we always end up talking about that as a firm. But we're focused on partnering with other founders, managers, private equity firms. We invest in technology, consumer, business services, and financial services. And happy to be here today. Thanks for having me.
Thanks, Harv. Dominic, let's go to you. Tell us a little bit more about Vaquero Capital and what you do there.
Thanks, David, and thanks everyone for joining here today. I'm Dominic Chan. Been with Vaquero Capital for 4 years. I head our financial sponsors group and business development efforts here at the firm. I spent most of my finance career at Goldman Sachs and at Barclays in New York City, and then back in San Francisco for the past 10 years or so. Vaquero is a middle market software focused investment bank based in San Francisco. We were founded about 11 years ago. We really focus exclusively on working with private equity backed and entrepreneur led software companies in the broader enterprise software space. We've done roughly 115 deals since our inception, and we're named the Tech Bank of the Year, Tech Boutique Bank of the Year 5 years in a row by the Global M&A Network. So really looking forward to the discussions here today, and thank you all for joining.
Thanks, Dominic. Really happy to have you on the program. And Andy, tell us about Houlihan Lokey and what you do there.
Sure, sure. Houlihan Lokey, we are a global investment bank. We have over 2,500 employees across 35 some offices worldwide. We really focus, our largest practice area is M&A, and we really focus on the middle market. We have been the #1 M&A advisor in the U.S. for 6 or so consecutive years, and now globally with an acquisition we did of GCA Advisors, which transformed our technology practice, and we now have the largest technology practice of investment banks worldwide as well. I've been with the firm for 20 plus years. I'm in our sponsor coverage practice and cover financial sponsors, meaning private equity firms on the West Coast.
Okay, super. Thanks, Andy. And let me now turn it over to Nadim Malik of SPS by Bain & Company. Nadim will introduce himself and then also present some data to shed light on the current state of the deal market. Nadim?
Thanks, David, and thanks everyone for joining us this morning. Hope everyone's year is off to a great start. And if you're like me here in the Northeast, you're enjoying some nice spring weather. Definitely put some smiles on people's faces. At SPS by Bain & Company, we're continuing to do what we do best, which is helping our clients position themselves for relevant deal sourcing opportunities in the current or any market for that matter, using data analytics, technology, and automation. Well, in case you hadn't heard, deal activity in the PE and M&A world is down. The questions on everyone's minds are, is it starting to pick up? If not, then when will it rebound? And in the meantime, how do we get deals done? I'm really looking forward to hearing the perspective of our panelists who are great at what they do and have been doing it for a while, each of them grappling with many of the same questions as our audience. And before turning things over to them, I wanted to spend the next 8 to 10 minutes walking through some slides to help frame our conversation. Starting with what you see here on the screen, which is total private equity and M&A deal activity in the US and Canada. Now that the dust has settled on 2022 full year data, we can offer a more accurate comparison year over year. Following that dramatic increase in 2021, deal activity declined by just over 15% for the year. It's important to note, despite the decline, deal activity came in at the second highest level we've ever seen since we began tracking the data. Also, this was the second consecutive year that private equity outpaced corporate buyers as a share of the overall M&A market. This was a first last year and a trend that will perhaps continue to persist in the years ahead. More to come on that. Moving on to the next slide, it's the quarterly numbers that really tell the current story, I think. Since last year, they have been trending downwards. If you look at prior years, quarterly deal counts almost always trend up or at least stay flat as the year progresses. But that wasn't the case last year. Quarter one is currently down 32% compared to Q1 last year. Now there's some data lag effect here, dragging down Q1 numbers. And once we have a more complete picture, the amount decrease will come down, but it's still going to be pretty dramatic. In case anyone's curious, when we ran this webinar a quarter ago and looked at Q4 year-over-year numbers, when there was a similar data lag issue for Q4 numbers, the quarter was down 40% at that time. So at 32%, Q1 is not down as much. Moving on to the next slide, here's a look at the most active sectors over the last 3 years, broken out between strategic and PE deals. Industrials has been the most active sector, followed by business services and technology. For each of the sectors, you can see the volatility over the last few years across the board, from a dip in 2020, the COVID year, and subsequent spike in 2021, followed by what you could say is a more normal levels in 2022. PE has the edge over corporate buyers in virtually all the most active verticals, especially in industrials, business services, and healthcare. And on the other hand, financial services, media and telecom, and energy sectors saw a higher share of strategic versus PE deals. Moving on to the next slide, here's a look at the most active sectors for PE activity only for 2022 compared to the prior 2 years. with industrials down less than 10% compared to last year, and business services transactions down barely at all. On the flip side, tech deal activity saw the sharpest decline year over year. In terms of deal size, the smaller end of the market, which we categorize as 10 to 50 million in EV, represents the lion's share of all deal activity, which is due in no small part to, if you go to the next slide, the ever-increasing trend of the buy and build and roll-up strategies in private equity. The increase of add-on activity is one of the main drivers behind PE outpacing corporate activity. The trend continues to accelerate, reaching 2.5 add-ons for every platform in 2022 and rising dramatically so far this year to 2.8 add-ons for every platform. It's going to be interesting to see how far this trend will continue. Will it surpass 3 add-ons for every buyout? What about 4? I think it's really hard to ignore this trend if you're a PE firm, and we're certainly seeing an increasing focus on it on the deal sourcing side with our clients, meaning they're not just leaving it up to their portfolio companies, but becoming more actively involved in growing their platforms through acquisitions and sourcing. Moving on to the next slide, breaking down sector activity by the 4 deal types we track, which are add-ons, buyouts, financings, which is what we call non-change of control transactions, and recaps. Financial services saw the greatest add-on activity relative to other deal types over the last 2 years, while financings have remained an important investment strategy in the technology sector during the same period. Having said that, add-ons comprise the biggest share, if not an outright majority, of all transaction types for each sector for every year over the last 3 years, which is pretty wild. Moving on to the next slide, looking at private equity pipeline data, the median number of deals PE firms saw, or perhaps more accurately logged, in Q1 was 175, which is the lowest we've seen over the last 3 Q1 time periods. Now, it can be a bit challenging to try and use this data to forecast closed deal activity in the quarters ahead. You might think, in theory, higher deal flow should mean more closed deals and lower deal flow should mean less deals. However, it's important to keep in mind that a higher median number of deals seen could be because PE firms continue to get better at deal sourcing and processes having a broader reach and not necessarily translate into more closed deals. Moving on to the next slide, there is a lot to unpack here. And let's start with the data point that there were 908 unique intermediaries that sold at least one company of 10 million or greater in EV in the US or Canada last year. That compares to 916 active intermediaries in the prior year, which may lead one to believe that there wasn't a lot of change or turnover in active intermediaries, but that's just not the case. In fact, of the 908 intermediaries, 132 sold a business for the first time in 2022. So these are new entrants to the market. And over 360 that were active in 2021 did not do a deal in 2022 for one of a variety of reasons. That's a total churn of about just under 500 firms over the course of the year. And that's just at the firm level. It would be even greater at the professional level. This means that literally every day something is changing in the intermediary landscape for a private equity firm in terms of their coverage and outreach, which begs the question, how often of a data cleanup exercise is good enough if you're a PE firm? Keeping contact data current is both a challenge and a huge focus at SPS because we know how critical it is in forming the right relationships in a timely manner on a continual basis. Before leaving this slide, on the right side, I just want to point out that these are the most active intermediaries that sold companies in a change of control transaction to private equity buyers. Now, when you look at these names, these are kind of well-known, established players, typically running broader processes. But I also want to remind folks that of the 908 intermediaries, 69% did 3 deals or less. And according to our sell-side process index, a lot of these boutique firms are typically running quieter, below-the-radar processes, and which means there's still some inefficiency and opportunity on the part of private equity firms to try to be as data-driven and tech-driven to make the right relationships with this landscape, ever-changing landscape of intermediaries, and see those deals that are maybe less competitive. Moving on to the next slide. This is my favorite slide. I really love it, and I want to take a moment and give a shout out to our team for putting it together. Thanks, guys. Really, really well done. This shows the top 25 sell-side advisors active in 2022 in terms of number of deals, further breaking down their deals by size range. And while I'm giving shout-outs, I will also give one to our panelist, Andy, and his firm for taking the top spot. And I'm just going to give the audience a few seconds and let this slide sink in. Hopefully some of you will appreciate it as much as I do. All right, moving on. And finally, complacency is the enemy at SPS. We're constantly listening to our clients' requests as well as innovating on our own. And this slide shows just a small sampling of our product enhancements over the last several quarters. Starting at the intermediary profile level, we've added a tab that allows our clients to see the pipeline of deals that an advisor has shown them with the outcome. Who bought the company? What type of process was it? Or in some cases, if the deal didn't end up transacting, is it a potential broken deal worth revisiting? At the PE firm and corporate profile level, we've added a separate tab that allows our clients to see what that firm has been exiting by sector, by date period, in a very comprehensive manner in one place. Then, of course, there's our new industry taxonomy, which is close to 500 subsectors deep, developed by our parent Bain. It's a real game changer compared to SIC codes or generic industry trees developed by others to help glean efficiently, very granular takeaways and analysis that you really can't from other large volume, sources of information. And finally, for our clients focused on larger transactions, we've added more granularity on deals greater than 1 billion in EV, breaking them down further into the subcategory ranges listed here. With that, I'd like to turn it back to our moderator, Mr. David Toll, and our panelists for our discussion and Q&A. Thanks.
Thanks, Nadim. Lots of great data there. I do have a quick follow-up question for you, Nadim. Just given what's going on in the market, are you seeing more stalled processes or broken deals than in the past? What's your sense?
Yeah, so every year we do this analysis in the May-June timeframe. So the next time we do this webinar, we'll have more concrete data around the length of time processes are taking, what percent are actually closing, and how that's trending. But I can tell you, David, and I think we'll hear it more in our panel anecdotally, the conversations that we're having with private equity firms and our relationships on the investment banking side, that, yeah, processes are being delayed in some cases because of the mismatch of expectations on buyers and sellers and uncertainty. They're being pulled back. So we don't have the hard data yet, but certainly I think it's pointing in that direction that there is going to be a larger percentage of deals that are launched in the current market that don't end up transacting or are just going to take longer to close. But I'm sure that the panelists probably have more real life experiences with that in the current market.
All right, super So thank you, Nadim. And let's now kick off the discussion portion of the program. I'd like to remind everyone to please keep the questions coming through the question feature on your control panel. I know a few are queued up, and we will get to them. Before we jump into full-blooded discussion, I'd like to start off with a polling question to take advantage of the large audience and market intelligence that we have right here on this program. So my first polling question for everyone is, how do you expect the number of platform deals, just platform deals this year, to compare with last year? And just give me a moment to launch the poll. All right, so go ahead and make your selections. All right, so I'm gonna close the poll and share the results. All right, so this is, I guess, not too surprising, although the past couple of webinars, the audience has been surprisingly optimistic about the pace of deals, but this looks a little bit more like reality may have sunk in. So more than half of you expect the number of platforms that you do this year to be down from last year, and another almost quarter of you expect it to be even with last year. Okay, let's go to the second of two polling questions. This one is very closely related, and it's, how do you expect the number of add-on deals this year to compare with last year? So go ahead and make your selections. Give you a moment more. Okay, so here are the results for add-ons, and here it looks like there's a little more optimism about the pace of add-ons this year. About a quarter of you expect the number of add-ons that you do to be up to 10% higher than last year. So with that, I'm going to start with some really big questions for our panelists, and then we'll drill down into some specifics as we move along. And the first question is for each of the panelists to address in turn, and Harv will start with you again first. What is the quantity and quality of deal flow like out there right now as we speak?
I would say that, as Nadim mentioned, the quantity is definitely down, but we have seen the quality, there's been a chasm. It's either been really high quality because folks are having to bring out a deal for one reason or another, whether it's taking a mark, and so they're willing to sell an A+ asset because they know that those multiples have stayed pretty tight, or people are in a liquidity crunch and they have to do something. And so there's a pretty vast chasm in terms of quality, but there are some good deals coming to market that we're excited to see, but you're certainly not getting a good deal on that.
And Harv, what's the outlook for the rest of the year?
I'm a pessimist, so I think that it stays either flat or gets a little bit worse. We talked about, I'm sure there will be some discussion around a recession. I think that this will be a slower matriculating issue throughout the year, and so I think what we're feeling now, we'll definitely be feeling towards the back half of the year as well.
Okay, so interesting, kind of a barbell market with both A-plus assets out there, but also some stuff with hair on it, with folks in need of liquidity. Dominic, you guys, as you said, specialize in software and technology. What are you seeing in terms of quality and quantity of deal flow?
Sure. So to echo Harv's point, the total quantity of deals, inclusive of high quality assets, is significantly down, certainly from the 2021 levels. I would say the story for 23 is very similar to that from what we're seeing, starting really in the second half of 2022, in that you really have a bifurcation of two markets. On one side, you have, low quality assets, the mega burn type assets that are your typical, Silicon Valley VC-backed companies. That part of the market is still getting decimated, certainly was last year. We think it's going to be the same for the rest of this year. There's hardly any IPOs, not a lot of SPACs going on. I think 97% of SPACs that were formed didn't actually find an asset to buy. Fundraising rounds for these, Sequoia type deals are down significantly, down rounds from what they were in the prior rounds. On the flip side, if you have, what we like to call kind of A- or better assets, so quality software companies that are growing, 20+%, operating at break even or better, you're actually surprisingly seeing relatively robust valuations. Maybe not quite at the Q4 21 levels, but historic to the mean, still very high, and that's primarily driven, by all the dry powder, primarily amongst private equity. We could get to that discussion a little bit, but we're actually seeing decent flow and decent pricing, certainly for our active deals and ones we just closed, and we think that's to continue through the rest of 23.
Okay. Yeah, sounds complicated, but like there's still plenty of opportunity out there. And Andy, what's the quantity and quality of deal flow look like for you guys?
Yeah, so similar to Harv and Dominic's comments and the data that we saw, overall deal quantity is down. There's no doubt about it. And in this environment, deals are harder and more expensive to finance. Diligence is taking longer. Overall, we're seeing deals are just taking longer to close. So the quantity is down. The length of time they're in market is up. And echoing the other panelists' comments, I mean, we have seen at Houlihan a definite flight to quality, and this is really across all industries, not just tech, but also within tech. That it's those recession-resilient, highly recurring revenue models that are going to market. Anything else is frankly sitting on the sidelines right now. The other thing I would comment on is we're also seeing, this is tied to the financing markets, which I know we'll talk about later, is deals have generally skewed smaller, as those larger assets that are traditionally financed in the syndicated loan markets, those are also sitting on the sidelines. So it's smaller yet higher quality deal flow overall.
Okay, thanks, Andy. And Nadim, would you like to weigh in on maybe the outlook for the rest of the year, given your experience with the data over the years?
Yeah, David, my response and my thinking has been that things should pick up in terms of closed deal activity towards the second half of this year, but I'm just looking at the date, that's 2 months away, so it's right around the corner. And are we seeing enough change in the current market? So yeah, it's Harv made a good point. It could be a slow recovery or an environment where this persists a little bit longer than people think. Maybe it's not a terrible recession, but it's just kind of a down to flat environment. But at some point, I do think because of the dry powder, I do think because private equity firms need to both sell deals and create liquidity, and I do think there's only so much, if you're an entrepreneur or seller, that you just want to keep waiting, that, hey, maybe valuations are going to come back or the market's going to return. I'm a little more optimistic, and I still want to say, let's see how it turns out. But I do want to say that I would expect things to pick up in the second half of the year.
Okay, that's definitely welcome news. And I've been covering the private equity markets long enough to know that almost everything hinges on the health of the credit markets. And when the credit markets have shut down, and it's occurred at least a few times in my career, deals just come to a crashing halt. So with that in mind, I wanted to ask Andy just how cooperative are the credit markets being for sponsor-backed deals, and what are some of the more sort of creative or innovative things that you're seeing in the credit markets?
Sure. Like overall, the financing markets they're still choppy, but they are, as of late, starting to show some signs of life. When you go to the syndicated markets for broadly syndicated loans, they're still largely closed for new LBOs, but they have opened up as of late for refinancing, albeit more expensive. The cost of capital is probably 2 times what it was a little over a year ago. The direct lending markets are more receptive, including for buyouts. I mean, you saw even reports this week that Vista is looking to the direct lending market to refi their very sizable Finastra asset. I think that would be the largest direct loan to date, if I'm not mistaken. So the lending markets appear to be thawing a little bit, but the issue is still the cost of capital. As I said, it's 2 times what it was a year ago. So that's definitely limiting leverage that can be put on companies. And to your question, David, given the challenges in the financing markets, what are some of the creative ways we're seeing to bridge the valuation gap or the financing gap? A couple things we've seen as of late is an increase in seller's notes, so a form of financing where the seller is agreeing to take back paper as part of their compensation. What's interesting about this is it's typically a cheap cost of capital relative to other junior financing options for the buyer. We're also seeing an increasing use of earnouts or payments that are tied to future performance of the company financially. So those are ways we're seeing some bridging of the financing gap.
Thanks, Andy. Harv, you're in the trenches actually doing deals and trying to line up financing for transactions. I'm curious what you're seeing from your perspective.
I would say that from our perspective, as we've gone out looking for deals, we've been pretty judicious in focusing on deals that can transact. So focusing on, is this a deal where we can take a significant minority, or is this a deal where it has a portable cap structure? As Andy mentioned, the syndication loan market is effectively closed, and so we know that that's not a good use of our time. And so as we're talking to other DPs and trying to generate opportunistic deal flow, we're pushing hard on, do you have a portable capital structure in this deal? Is there an opportunity for us to take a significant minority in this deal where we don't have to ruffle any feathers with the current capital stack? So it's been a focus for us, because it's been, to Andy's point, the markets are thawing, but they're not back. And so we're taking a different approach of trying to get deals done.
And Harv, if you're looking to do an add-on deal these days, I'm curious how those get financed.
We've had a big roll-up strategy at HGGC over the years, and so we're having to reassess that and think through, is that still an opportunity for us to go and attack? We've looked at a couple of them recently, and the lending market has not been favorable as it relates to add-on. Every portfolio company that we have is different. And thankfully, we have an amazing capital markets person at our shop who didn't foresee this, obviously, but he put in place capital structures that have been pretty helpful in us continuing on the add-ons. And so we haven't felt any real pain in terms of having to go out and figure out creative solutions for add-ons. We've been able to just kind of keep status quo and keep using the cap structure that we currently have.
Okay, that's a good wrap up on the credit markets and what's going on there. Now I'd like to shift gears a bit, get into some real fun discussion about what industries are hot and of high interest these days, right, in the M&A market, and maybe what's cooling off a bit. Dominic, why don't you take the lead?
Sure. Couple areas within enterprise software that we see are certainly very hot in today's market. The first one being the broader supply chain and logistics space. There is no question that worldwide we have severe supply chain issues in various industries, and you see really innovative companies that utilize technology and address those pain points. We did a deal a couple years ago for a company called Megaya that did supply chain for warehousing in ports. We sold them to LLR partners, most recently recapped to Apex partners through the Digital Fund in New York City. Great space. And the second is the broader kind of actually food tech / compliance space. You see some really interesting companies alongside training and compliance for the broader food industry. You know, you take a step back, at the end of the day, everyone's got to eat, right? And so you see interesting software companies that address things around labeling compliance, shipping, logistics, and the like. Thoma Bravo, through their Q8E platform in the UK, recently acquired a business called Red Zone, based in Miami, for about $1 billion. Phenomenal transaction there for all teams. We advised a company called Alchemy Systems a couple years ago from the Riverside, and actually worked with Andy's firm on their exit to Intertech. That was a great outcome for Riverside and the company. The third area that's pretty hot is the broader kind of restaurant / hospitality tech space. Somewhat surprisingly, given the slight slowdown in the overall consumer industry. You got to remember that a lot of the spending has been really stimulated by both free and or easy monetary policy and the COVID kind of stimulus. For whatever reason, it seems like both the eating out and traveling space continues to be red hot. I think that partly has to do with the demand in that space, given people are locked in for 2 years and weren't able to do that, and now that's roaring back. And then the last area that we find pretty hot within software is the broader education tech space. I was at a ed tech conference last week called ASGGC. There were over 10,000 people attending. I think one thing that's pretty clear is post-COVID, online training, content, and analytics have proven to be a very sustainable model post-COVID. It's certainly a space that's going to continue to pour a lot of new capital into space, given the sustainability of that market. And then, David, to your question on areas that are maybe not so hot, I would have to point out probably cryptocurrency. Blockchain, I think, is a pretty interesting technology, but crypto, for whatever reason, I think we've all seen what happened certainly with FTX and many other names. There's just certain actors, and the way it's structured is just, there needs to be a lot of more regulation probably to in that industry. So we're a little, I would say, bearish on that. And then the other space I would say that's a little, or was challenged, that's actually seen a nice U-turn more recently, is the energy tech markets. In 2020, when oil went negative briefly in March, that was certainly a scary time for the broader commodities market. It really continued through 21. That industry has dramatically rebounded. We actually just closed the deal that hasn't yet announced in that space. We have another very major from that deal. Wood Mackenzie recently got spun on Veris by Veritas Capital for several $1 billion. So you see a lot of positive tailwinds for that market that's really made a huge comeback.
Okay, super, Dominic. And Dominic, I want to stick with you for another question. This came directly from one of our registrants, and they wanted to know what's going on with industrial inspection software and critical infrastructure software markets. Are you seeing a lot of deal flow there, or what's going on?
That's a great question. The broader, infrastructure tech space has been very hot. Certainly stimulated by what's going on in DC, their spending, but more importantly, it's an area that needs, significant investment and a very large market opportunity. You break that broader, area down to more thematic areas such as, construction tech, right, which includes both engineering, architecture, home building, and construction for commercial facilities. Red hot space. You've seen a lot of market activity. I think we actually recently ran some analytics on that, and there's roughly been 4,000 plus deals in the broader infrastructure and construction tech space, with 173 billion capital invested in the space over the last 12 months. Big strategic in the space, including Procore, Trimble, Hexagon, just a lot of companies called Project Mates. And in Texas, you have financial sponsors such as Thoma Bravo being very active in the space. They bought a business called HCCS in Texas, along with Command Alcon and Foundation Software, accounting software for the broader construction industry. We did a deal for a company called Hyphen Solutions, which did supply chain for the home building industry. They sold to 11 of the top 15 home builders in the U.S. Most recently recapped as Stone Point Capital, a $30 billion private equity firm in New York City. So yeah, the broader space has been very hot. I would say the last more thematic area that is drawing a lot of private equity interest is the broader field service space, inclusive of maintenance, repair work, connecting frontline workers to back office ERP and areas like that.
Okay, thanks, Dominic. I really appreciate you giving some recent examples in those categories too. Andy, anything to add on that topic of maybe industries or subsectors where deal flow is either heating up or has sort of held up surprisingly well?
Yeah, I mean, across the firm, and this isn't specific to just technology, but it also applies to technology. We've seen deal flow and valuations be resilient in any sector that is defensive, recession resilient, highly recurring revenue models, generally more B2B than B2C models. Within software, strong, has to have strong unit economics, strong margins, strong retention rates. And frankly, there's in this market, there is a demand for cash flowing assets. It's highly unlikely we'd be taking to market a cash burning asset in this market.
Right. All right. Speaking of what's coming to market, Harv, I want to know from you, are you a buyer or a seller in this kind of market? What's where do you stand?
Yeah, two questions there. I'll start with being a buyer. I would say that in times of volatile environments, we certainly have a higher bar as a buyer, but our LPs do not give us money to completely sit on our hands in any environment. So we are always leaning into being buyers. And I will say that history has been favorable to private equity firms that have invested during times of slowed growth or even in recessions. So we say we're always buyers, but we certainly have a higher bar out there. I would note though that in a weird way at HGGC specifically, we don't hate the current environment. As I mentioned previously, the deals that we're looking at have come with some sort of opportunistic opportunity, meaning that when a GP is selling a really good asset, there's a reason they're doing that. It's usually for a mark or they're fundraising, and as fundraising's gotten tighter, they're willing to have discussions around an asset that maybe they would have sat on for a while. And I also will admit it's been helpful, as Nadim mentioned, that when we are competing in a process, it's usually not with 100 other groups. No offense to Andy or Dominic, but HGGC doesn't love participating in those. So our principal-to-principal dialogues are increasing and making us buyers, and that's creating narrow deals for us on really good businesses. So we lean in times like this.
Okay. And what about the portfolio of portfolio companies that you've already assembled? Are you feeling this is a good time to come to market or not?
Yeah, so I'll answer this question two ways. I'll try not to make it an HGGC commercial, but we're very focused on the middle market and buying good businesses in the middle market and making them great companies. That's our tagline. But what that really means, and Andy mentioned this as well, is when we're out there buying a business, we're looking for defensible businesses, high ROIC, recurring revenue, non-discretionary. And so we've been that model. We've been the beneficiaries of our portfolio staying strong and being able to manage inflation and slower growth. That said, I certainly have friends out there and who are feeling distress in some of their discretionary consumer businesses or in businesses like end markets in tech that Dominic mentioned. So there's certainly signs of distress out there. We recently bought a DSO from an awesome founder. We actually bought it from Andy and Houlihan Lokey. And throughout our entire diligence process, we were just keenly focused on, is this business going to be able to manage slow growth or a recession? And I will tell you, I don't think anyone in our shop feels like we got a great deal on the business, but we're confident that in times of distress that business will be able to manage through slow growth or even a recession.
And Harv, DSO, I'm not familiar with that acronym.
Dental, I hate when people do that, so I apologize. It stands for Dental Service Organization. It's
Okay.
basically, we're rolling up dental offices.
Okay. Yeah, I would think people got to keep getting their teeth fixed and cleaned in an environment like this. All right, we've got a lot of questions coming in from the audience, including a very pointed one, which is, what are effective sourcing strategies in adverse market conditions? Which is basically the title of our program, and they're like, when am I going to hear some advice that's been promised? So let's make sure we spend some good quality time on this question. I'm going to start. We'll go back to Dominic, and again, it's really the topic topic du jour. What are some good deal sourcing strategies for the kind of slower deal market that we're in right now?
Sure. To your point, David, so in the market that we're in, utilizing effective and thoughtful strategies in deal sourcing is even more important, certainly than it ever was before. We like to think about effective deal sourcing kind of in three buckets. One is inbound, one is outbound, and the third is utilization and cultivation of high quality data and finding those good deals. Inbound, includes everything from sponsor relationships, which are extremely critical. I think 70+% of our deals today are from that avenue. And that also includes kind of inbounds from client relationships. Your former clients oftentimes are your best word of mouth. And so staying on top of those relationships are extremely critical. The second, being outbound sourcing strategies. Firms that, take control of the quantity and quality of companies they reach out to really creates a much more consistent and measurable deal flow than those that don't. And outbound deal sourcing offers also kind of compelling opportunities to identify, promising companies even earlier on in their life cycles, far beyond their competition, and then having a systematic approach in tracking those relationships, right? Because the company that you meet with at conference XYZ, 3 years ago, that maybe a little small. You fast forward that to today, they might be right within your wheelhouse, but you must, really stay on top of them. And then the third point is, utilizing effective data to find, the right deals, whether it's creating lists, identifying who your target companies are at various conferences. I'm sure many in this audience, including our firm, we use, SourceScrub, which is really one of the best tools out there. They're backed by Francisco Partners, really a tremendous source. And then folks like, SPS, right, that have really interesting and targeted data in our industry are all, very important tool sets to use. I might add also on the relationship part, there really is no substitute for, I think, in-person communication and relationships, despite how effective and sometimes efficient kind of virtual meetings are. There was a report that came out, I think, 2 days ago by Morning Consult, which is a big data firm, particularly around polling and kind of travel data and political data and things like that. And they said, business travel may never come back the way it used to. And I actually found that a little disappointing to read, not surprising though, but I think, just go out and go see your clients, because one, they appreciate it. And two, I think it's, as a company, you deserve to go see your clients, right? There's nothing like that in-person communication and effectiveness in cultivating that, and building it over time. I think it proves to be much more effective than not.
Okay, good advice, Dominic. Appreciate that. And Andy, let's turn to you at Houlihan Lokey. We're in a slower deal market, so what are some effective strategies for getting folks to think about selling their companies?
Yeah, I guess a few things. One is what has been effective for Houlihan, and I wouldn't say it has changed the way we approach sellers of assets all that much. What has been effective, though, is as our firm has grown, as we've made acquisitions, brought on more senior talent, we've gone deeper within subsectors and industry verticals. And so as our bankers go deeper in a sector, they obviously spend a lot more time and are a lot closer to the playing field and the various assets. So staying in front of all of those assets. I mean, we still, even in this environment, find a healthy number of motivated sellers, whether it's the private equity firms that have a need to return capital or get a return, or whether it's the founder owners who have built up great businesses and are looking to bring on a strategic private equity partner, or just have some family planning or life cycle dynamics. We're finding very open conversations and receptive sellers on the other end. It then becomes a conversation that's shifted to, okay, let's talk about the new valuation reality. Where are we with respect to valuations? And obviously we're off of peak valuations, and we're talking about now more like a moving average valuation. And candidly, where we are today from a moving average, we're still near all-time highs from a moving average. If you look at over the course of, call it 3 or so years. And then what with respect to market timing should we be thinking about? When is the right time to go to market? How do we balance the challenges we've already talked about in the financing market? How do we balance that with the economic outlook? The flip side to that and waiting is it's not a very crowded playing field right now. If you were to go to market right now with a high quality asset, you're going to get a lot of attention. You're not going to have nearly the same competition that you would have encountered in 2021, when oftentimes the answer from a lot of our private equity clients was, sounds like a great asset, but we just don't have an angle or a thesis, and we're going to have to pass here. Less likely to get that answer. So it's much more the conversation has shifted to what's the valuation reality and what's the appropriate market timing.
Okay. And Harv, what's your approach been now that we're into an environment with slower deal flow and higher cost of capital, prospect of a recession bearing down on us? How does that change your deal sourcing strategy there?
Yeah, I wish Andy or Dominic or had given some silver bullet, and the people listening that we could say, oh, this is some new magic thing that we're doing. But I think what you're hearing, and I'll continue to beat that drum as well, is it's a lot of doing the same thing over and over and over again, and it's just going back to the basics and hitting that fastball down the middle over and over and over again. For HGGC and with the team that I work with, we focus on kind of 4 different buckets of sourcing. Intermediaries, talking to people like Andy and Dominic. We focus a lot on principal to principal dialogue. We call it direct sourcing. So having lots of dialogues with other private equity firms, going to attending conferences and managing those conferences and being proactive before you get to those conferences. And then all of that kind of ties together in what we call thematic sourcing, which is our deal team and our business development team working together on creating deep dives within certain end markets and certain sectors. I like what Dominic said. We kind of overlay all of that with technology. We use SPS a ton. We use SourceScrub a ton. We use a lot of technology to try and help ourselves as we think about going and trying to find opportunistic opportunities. And we use that term a lot right now. When you think about your specific question in terms of sourcing deals in a slowdown and how do you do that? You can't sit on your hands anymore. We can't just sit back and hope that Houlihan, Lokey, or Vaquero is going to call me and say, hey, I got a great deal right down the middle for you. I have to go out and actively be opportunistic and try and create that opportunity. And we create those opportunities through those buckets that I mentioned. And it's just a lot of interaction. Like Dominic said, it's a lot of picking up the phone and talking to our peers and in the private equity space and seeing, is there anything in your portfolio that we should be discussing? Is there any reason why any deal that you think should transact over the next 12 to 18 months? And pushing on that thread over and over and over again. So unfortunately, it's not, hey, you can just sit back and cross your fingers. You've got to go out and hit the pavement really hard.
And Harv, to the extent that sellers are a little just less excited about selling, after valuations have peaked, how do you get them excited about selling, if that's possible? And are there other kinds of transactions that you pitch them, short of a sale, that could be of interest?
Yeah, I think, like I said in my previous comments, I think that the current market is kind of a barbell in that it's lending itself to not having to work overtime to convince people to do something. On one end, most of the deals that we've been looking at have had some sort of forcing function attached to it. As I mentioned, GP transactions, when they're selling an A+ asset, and Andy mentioned this, it's the market is, you're going to get a lot of attention for A+ assets. And they're looking, a lot of people are fundraising right now, and so they need a mark to be able to go and return some capital to their LPs. And on the other end, you have founders who are could possibly be spooked by the current environment, and they're finally willing to engage. I will tell you that we had been chasing this business for 5 or 6 years, and begging the founder, let's have a dialogue, and he just kept putting us off. And then about 8 months ago, he finally called and said, hey, I want to have a conversation. That story actually doesn't have an happy ending, because the reason he wanted to have a dialogue was because his business had been hit pretty hard. And so we weren't able to engage there. But the convincing has gotten less difficult. But as we talked about previously, the quality or the quantity is just not there either. And so you're having to pick and choose your spots to go and focus on trying to find businesses where you can transact, whether that's a significant minority or, again, like I mentioned, a portable cap structure, because there are certainly opportunities out there that there's just no way of getting a deal done in this environment. And so you have to be creative in terms of what you're seeking.
And Harv, a portable capital structure, I wonder if you would just define that a bit for me.
Yeah, sure. I'm not an expert on this either, but when you're getting into a transaction, you can create a capital structure that will move with the transaction. So you don't have to go back to your lenders and redo the entire thing. It's just the capital structure will stay in place as a transaction happens. It usually has to be done on a minority basis, so you can't have a change of control. But it's a cap structure that if you buy less than 49% of the business, it just stays in place as it was.
Okay, so that sounds like a good hedge against higher interest rates if we get into, an even worse deal environment.
100%.
Okay, we've got about 15 minutes left of the program and plenty of questions coming in from the audience. So I think that's going to take the balance of the time. Got a really interesting question here on how can entrepreneurial acquirers, so these are folks with, say, a search fund or pledged capital network, how can they work with private equity intermediaries to find their one single deal? Really interesting question. Dominic, you want to take a stab at that? Are you sympathetic?
Sure. Entrepreneur-led companies are often great platforms to find, smaller tuck-ins per se. I think having dialogue and relations with both intermediaries and private equity folks would be key to that. Certainly, folks like Harv and Andy's firm and our firm have, a treasure trove of, we call them probably lists, right, of smaller companies that may not necessarily be a fit for us to bank on the sell side, and or a platform or tuck-in acquisition for a larger private equity platform. And so founders and entrepreneurs who are looking for call them more micro assets to potentially join synergies with. We do that all the time. We're happy to have a dialogue and be helpful in any way we can with introductions. Hopefully, as that company that ends up acquiring the business gets larger over time, they'll reach out to us when they're looking strategic alternatives. But either way, always happy to be helpful. And I think there's plenty of different avenues for entrepreneurs to go find interesting assets. Go attend industry conferences. Right? It's a great way to network and meet other founders and CEOs.
Okay, next question comes in. Do you see more junior people leading deal sourcing efforts for private equity firms? And this questioner has the feeling that historically this was more of a partner role or more of a senior role and seems to be transitioning. I don't know, Nadim, do you have a feel for that or sense for that?
I do, David. I would say more and more of the active roles that I'm aware of, just working with private equity firms, primarily around deal sourcing and business development. We end up doing a lot of networking and connecting people that are looking for work, as well as our clients and prospects that have an open role in the BD position. I'm not so. To answer your question is yes. I'm finding more VP and junior level open roles right now in the deal sourcing world in private equity. But this is not but the last remark that you said was, is there a shift in private equity firms thinking that's not there? It's not like the role is becoming less important. It's just that there's fewer, the senior private equity business development professionals are a little bit more established, and there's, according to our data, about 70% of committed private equity firms, committed funds, have a dedicated BD person, and typically there's a senior person heading that. So the trend in recruiting to junior level isn't an indication that private equity firms are now, thinking that junior level are more suited for that role. It's just that the senior level positions are a little fewer and far in between than the mid and junior level. So I guess what I'm saying is private equity firms are continuing to invest in this role. We think it's critical. I think private equity firms think it's critical, and it's growing. But they're growing it. They're expanding the team. At this point, we've gone from hiring the head phase to expanding the team phase.
Got it. So partly it sounds like a function of just the maturing of the industry and the maturing of that function within private equity firms. It's kind of naturally playing itself out. All right, next question has to do with valuations and how realistic are sellers being about valuations now, and how difficult are negotiations over valuations. Andy, let's turn to you for that, and maybe just kind of give us your sense for where purchase price multiples and leverage multiples are right now for deals that are getting done, and how tough it is getting folks to the table.
Yeah, both are down, leverage and purchase price multiples, no doubt about it. Leverage, as I talked about, it's a lot more expensive to finance, and I think the comment I've heard from our capital markets team, at least with respect to like first lien leverage, is 4 is the new 6 times with respect to first lien leverage, just given the overall lending environment and the cost of capital. There is capital there to plug that gap from 4 to 6 times, but it's very expensive. I mean, you're talking high teens to 20% cost of capital. So that obviously impacts valuation and deal flow. And our tech team maintains a index of publicly traded software valuations. And that's obviously shown, no secret, a steep decline. On a forward revenue multiple basis, I think it's down from like 15 times at some point in 2021 to just north of 6 times today. Private market valuations, while initially, this time last year, they took time to correct, which typically it does take time for private markets to catch up with public markets. We've definitely seen a correction, maybe not as severe as the public markets, but there's been a pullback for sure. I'd say where we're pricing the most pronounced pullback is in some of those really high flying assets that, back in 2021 were probably garnering mid-teens to 20 times type ARR multiples. Those have corrected now down to, I don't know, call it 10 times ARR. Frankly, from my perspective, it's unclear if these assets ever should have been valued at those levels. So we're definitely having to educate sellers, particularly founders, on the new valuation reality. And again, talking more like a moving average over a period of years as opposed to peak multiples where, yes, we're down. And to the point Harv has hit on a few times, and we're bridging that with creative financing structures or structuring transactions more on a minority basis to bridge that valuation gap and for founders to preserve more of the upside going forward and have a larger second bite at the apple.
Okay. Just going through the question list here. Let's go to, this is a question for Andy or Dominic. What's the best way for business development professionals to ensure that they're seeing all relevant deals for their firm? And are you still running smaller, more selective processes, or have things shifted at all on that front? You're going more broadly to more potential buyers. Andy, we just heard from you. So Dominic, why don't we start with you on that?
Sure, happy to. So to answer the first question, I think effective ways to make sure that a sponsor sees all deals. At the end of the day, deal making is always a two-sided relationship, right? Like most relationships in life. And we, really value folks, every firm that we work with, but I think we like most banks, I think, rank kind of tier our sponsor relationships. And I'll just say it short. Our top tier relationships are folks who we've worked with for many years, have a great relationship. They've been phenomenal buyers of our companies. On the flip side, they've also been tremendous resources, in their portfolio, and inviting us to bake-offs, for example, and pitching and sharing ideas for their portfolio companies when they're looking to exit. We also want to be as helpful as we can in sharing ideas, market insights with their portfolio companies. So it's really kind of a two-way dialogue relationship. And when that kind of all hits the check mark, it's almost like dating to a certain extent. That's, I think, the most effective way to ensure that that you see every deal from any bank. The second question regarding running more limited processes, if I understand that correctly, we still do for sure. It's always on a deal by deal basis, certainly based on what our client is looking for and what we think would be kind of the best fit, right? And starting to run a process. We actually did a deal recently in which we kind of did a pre-marketing phase. So, marketing a deal to 20 to 25 market participants, both a mixture of strategics and private equity buyers. Out of that group, we got 11 or so bids. And because of that, we never ran the full process. Now, on the flip side, we ran more recent processes in which, sure, we went on to a more broader set an audience and attracted a handful of bids as well. But it all depends on a case-by-case basis. I think the one most interesting note about the current environment, I think Andy and Harv alluded to that earlier, is the overall discipline amongst buyers is a lot higher than it was certainly in 2021. And so the average length in a process is certainly a little longer than what it was a couple of years ago. But that's not necessarily a bad thing. It's great that buyers are being very particular in what they're looking for, and that's all part of the process.
Okay. Next question, definitely for Nadim, and that is, what are the best technology tools to use to source deals, and what can we expect from this wave of artificial intelligence tools coming out? How will that impact the deal sourcing platforms of the future? Nadim?
Yeah, I guess I'm a little biased to answer that question in terms of technology tools and approaches, but I would say, I want to build on a point that Dominic made earlier. This is really about relationship building and planting seeds and getting on planes and shaking hands and lunches, and that's still very important right now. Now, how important that's going to be when my kids' generation is our age, we'll see. But for now, I can certainly say it has a huge impact. So tech tools, at any tech tool at your disposal that you can use to help you more efficiently drive and prioritize that relationship building is really where it's at, whether it's a CRM or a tool such as ours or private company databases and other things out there. That's the number one. There's nothing right now, at least, that's substituting that relationship building. It's facilitating that, creating efficiencies, creating reminders, and taking a more data-driven approach. In terms of AI, ChatGPT, things that are coming out, yes, all of these things over time are going to impact deal sourcing and impact private equity. I think it's very, very early in the private equity space. It's not a huge market. And so I think it's going to take time for some of those things and investors and companies to really do what truly AI type initiatives to drive sourcing. So I know we're running out of time, so I'll leave it at that.
Okay, Nadim, thank you for that assessment. And I think we'll let you have the final word. We are out of time on the program. I'd like to thank everybody for coming today. I'd particularly like to thank our sponsor, SPS by Bain & Company, for making the program possible. I'd like to thank our speakers for all their preparation and doing such an excellent job. Nadim Malik of SPS, Harv Barenz of HGGC, Dominic Chan of Vaquero Capital, and Andy Morrow of Houlihan Lokey. Everyone, enjoy the rest of your day.
Thanks, everyone.
Thank you.